Good afternoon, everyone. We'd like to request everyone to please take your seat. We'll be starting. Joey is already here, so we can already start. So good afternoon again, everyone. Happy Year of the Snake. It's my pleasure to welcome all of you to Colliers Q4 2024 Philippine Property Market Briefing. I am your host, Marie Crisarino Hoson, Senior Director and Head of Office Services Landlord Representation. In Chinese astrology, the Year of the Snake is considered auspicious. It's a time for rebirth, transformation, and personal growth. And judging for what we have been reading and hearing lately, the Philippine property market is in for a transformation this year. Whether to transform into something positive or negative, I guess we'll have to wait and see. But luckily, experts from Colliers will share insights that will help us navigate difficult times ahead and transform challenges into opportunities. I know everyone's excited to know how the real estate sector performed in the last quarter of 2024. We have prepared a packed program today. Joey is very excited to present the sectors of residential, hotel, and industrial, and Kevin for office. So in the next 2 hours or so, we at Colliers will provide you with insights, recommendations, and some assurance that will guide us through 2025. But before we do that, let's first acknowledge our event partner for this event, the Ascott Bonifacio Global City. At the end of the session, we would also like you to stay a bit longer for networking opportunity. Our team is here to answer any questions you may have about our services, which includes tenant representation, landlord representation, capital markets and investment services, valuation services, advisory and consultancy, project management, and real estate management services. So with that, let's begin our briefing. In our last market briefing, we highlighted office sector avoided 20% vacancy despite negative net take-up due to new surrenders from POGO firms. We also noticed increased investment among occupiers, which resulted in office expansions and stronger demand in the provinces. The residential segment, we meanwhile saw lukewarm demand, prompting developers to delay new launches. However, leisure-themed developments outside Metro Manila continue to shine and attract investors. The hotel segment, on the other hand, saw the most positive development in 2024 with exponential increase in MICE facilities, all-time completion of hotel properties, and tourists doubling up arrivals. The industrial sector too was quite robust with more industrial developers modernizing their properties, sustained demand for cold storage facilities, and the launches of industrial parks within integrated communities. In the other news, the US elections are over and now we're waiting for a collective bated breath if President Trump's campaign rhetoric will progress into a full-blown trade war with China. Locally, we anxiously watch our own elections unfold and we wonder how this will affect the current administration's economic policies. Yet there's so much happening right now, but one thing is certain, 2025 will be anything but uninteresting.
So thank you for listening. I hope you learned a thing or two.
It's information overload. I think we should give them a few seconds to absorb all the
Yes.
information for your 100+ slides. But we have already some questions here that was sent online. I'd like to call on first our Managing Director, Richard Raimundo, our Executive Director and Head of Office Services, Tenant Representation, Dom Mandaya, Senior Director for Capital Markets, Julius Guevara. I'm sure you have a lot of questions for Senior Director for Valuation, Paul Ramirez, and Senior Director for Advisory Services, Tim Tidoro.
I have a lot of questions for Paul.
Paul should take the middle seat.
I've been wanting put Paul on the spot. Now's my time. Chris?
Okay, before we call on Paul, Danes, do we have questions from the audience?
If you have questions, just raise your hand. Yeah,
Yes.
we'll approach you. Thank you.
So there's a question there, Danes. We'll start from the audience before the online questions. Sal.
We have a question here from the audience. Please introduce yourself, sir, and your organization.
Hi, this is Rafi Mendoza from Maybank Securities. Yeah, I actually quite agree with the property cycle that was presented in the sense that you have the residential, the offices being in the sort of in the dismal stage, whereas the retail and tourism being more positive, and then I guess the euphoric stage is industrial. I just want to know how you, at least on the pessimistic side, how long does it take to be in that cycle? Like, especially for the resi side, offices as well. Does it take a year or two, or longer than that, or 6 months? Yeah.
So it's really difficult to say because, as we explained earlier, the 8 years remaining inventory life changes based on how the take-up improves over time. But I'd say for the residential market, maybe around 2 years. You'll probably still see that in that stage. But that doesn't mean that there's no pocket of opportunities for certain areas in Metro Manila. So although it's overall 8, there are areas where you see lower remaining inventory life, such as Taguig, Pasig, Makati. Those are some examples. And also, as we've mentioned, the developers have really been careful about where they put up their next development. So they've been diversifying in terms of other locations and other products. So they're spreading also their eggs. That's it. For the office.
Kevin?
So for office, really depends, no. But just to give you like somewhat a proper context, no. Right now, we have 2.8 million square meters of available space, no? Not counting yung incoming supply in the pipeline in the next few years. And assuming that we do have a natural net office demand of positive 400,000. No? I say 400,000 because that was really the good years in terms of the office sector, where we without the pogos, purely demand from the strong BPO industry in the traditional sector. So 2.8 million divided by 400,000 square meters net positive. So 7 years at least. No, but right now, our forecast for the year conservative is just 150,000 net positive. So obviously the absorption would be much longer than 7. So it really depends on what the dynamics would be that would happen this year, because there's a lot of moving parts. Pre-pandemic lease is still ending. Questions about work from home are still there, which affect real estate demand, and also in a positive way, we're also getting more demand in the provinces, which will take demand in Manila kasi lilipat sila. So very optimistic 7 years, I would say.
Yeah, let me qualify that a bit now. We're talking about averages, but I don't think we should work on averages. As Tim pointed it out, we should look at the specifics because there are developers and locations that are doing a lot better than the others. Like one big developer here in BGC has 96% occupancy right now. So for them, it's undersupplied. Their supply is kulang. Diba? So, and then there are also different levels of quality of the buildings, the different positioning of the buildings. So, I think we should be able to spot opportunities in this kind of market.
Thank you, Dom. This is for Julius. So which would you recommend property investors to invest in? A highest yield in terms of appreciation or good rental rates in the next 5 to 10 years? I probably answered a portion of this earlier when I highlighted Julius's proposition on what property to invest in.
It's a very tough question to answer in this market, right? So, as Joey has presented earlier, industrial still looks to be quite promising. However, there are some, I would say, temporary supply situations where, you've seen some areas where there was a lot of development in the recent months, and especially this year, where the developers are now putting up warehouses all at the same time. So, but I think naman na that will be taken up quickly. The hotel market, depending on the location, still looks quite good. Both for residential and office, I think it's a buyer's market, and more importantly, an end user's market. So, for example, if you're an end user, now's the time actually to go to a developer and negotiate. No? I've been hearing that some developers are offering 20% discounts on the RFO projects because they're competing with the secondary market, no, which are selling at lower prices, as we've shown earlier. So it's a really good time for you to negotiate these good deals. On a yield basis, if you're an investor, I think it's going to be quite tough in the residential space. I did some analysis in certain areas. The net yields actually range between 2.8 to 3.2. That's even lower than the inflation rate. So you're not getting any capital preservation. Total yield na yan, including capital appreciation plus the net rental yield. However, I think people should look, if you're an investor, look closely at the strata titled offices. I was quite surprised that, on a current net yield basis, if you buy a property that was built 2010 and older, there are actually the good yields to be had. So that's a market, and that's even considering the current vacancy rates. I looked at it on a per property basis on how those properties were doing, and I was quite surprised. I think investors could take a look at that because in some places, some properties are doing better than what residential could offer. So there.
Yeah, thanks, Julius. This is for Julius, Paul, and Richard. Might want to add some insights. If you had $100 million, what asset class and where would you invest that in the Philippines? This is from Eric Manuel of Arch Capital. I saw Eric earlier.
I'd buy orange juice from Florida and sell it in Canada. So the tariffs. Okay. If I had the money today, I'd invest in safer locations. Like for example, the high-end subdivisions like Forbes, Dasma, Ayala Alabang. These continue to grow at 12% annually upwards, at least 12%. So that's a safe asset. Doesn't change, the market will always be there. It's always going to be Forbes and always going to be Dasma. And as I mentioned earlier, it's good deals in the residential space. 100 million, so that's what, close to 6 billion. I'd look at the Luzon Economic Corridor. That's a growth area because of the partnership between the US, Japan, and the Philippines. They're infusing a lot of infrastructure, spending there. Yeah.
Thanks, Julius. Julius is an expert at soft selling. Richard,
I agree with Julius. I think look at the undervalued assets right now. The thing is, it's normally under the radar. It's very difficult to find something that's being advertised as really good value. You normally, talk to the family owners to that level because one, they don't want to really advertise that the value of the property is the right value right now. But I think to add, I think a good one could be undervalued office buildings, value plus proposition. I think in the next cycle, because we're already seeing, let's say Makati, good example, Makati. And if there is a good building that you could get in Makati, that's the right price. And if you're in the long game, that's an interesting proposition for that amount of money. Refurb it a little bit, and then see the cycle through. Because we know that Makati, for instance, has a very low vacancy rate already. Fort Boni. I think the question now is finding that asset. Because sometimes it's more obvious in the residential field. Like you saw the slide we're in. If you go to, let's say, Rockwell, the pre-selling is at 500, 550. But if you look at the secondary market, you could actually get something at 250, right? So it's more obvious there. On a bigger scale of about 6 billion, then it's there. You just have to be more selective, I guess. So I agree with Julius on that one. Warehouses, that's interesting.
Thanks, Richard. I think we have a
Dean?
question.
Yeah, another question from the audience.
Good afternoon, everyone. I'm Paul from BPI Securities. So my question comes in three parts. So first, I guess it is a common knowledge now about how AI or artificial intelligence currently is seen as a potential risk for the BPO market. How do you see the impact of AI will be on the properties, particularly in the office sector for the next, I guess, 2 to 5 years, and how it will, and do you see opportunities coming from it, or? And second, create more. Right now, in terms of the law, I guess create more is already was already signed by the president, if I'm not mistaken. How will it affect office vacancy in the near term, given the provision in the said measure about the hybrid sector and the tax incentive, about the hybrid scheme and the tax incentives that comes with it? And in third or lastly, about the rental growth, what are our expectations in the rental escalation growth for offices this year? Thank you.
Okay, I'll take the second question first. Create more. We're expecting or we're waiting for the IRRs. We don't. Is there any update? No, we don't know the exact status of that one, because that will clarify the vagueness of some of the provisions of Create More with respect to, I think you're pertaining to the RTO 50/50, and if that applies to all investment promotion agencies like the PEZA, the BOI, and the others. So it will be good for that to be released soon so that we will have a more stable environment and we would know what to do, right? But just in case, well, the 50% mandatory RTO surely applies to PEZA already. So we expect that to help the office market. So we're just waiting if that also applies to the others. That's one. And then AI, we're having conversations with one of the developers outside before this briefing started. And they're saying, you know, AI is going to really disrupt the industry over the next 3 to 5 years. So the timeline that you mentioned is spot on. And it will really have an impact on, of course, the employees, right? And of course, related to that would be space. Now, will that, it's not, but that's not just dependent on that. Our office market is not just dependent on that. There are other demand drivers or sources of demand that we're expecting to come into the Philippines. So, as we've shown earlier, in terms of the office demand, despite the big impact of the POGOs, you were able to minimize the loss in terms of the net take-up. It was only just minus 45,000 square meters, despite more than 200,000 square meters being given up by POGOs. Actually, that's not the story. The story is that the office market is resilient. We recorded almost 800,000 square meters of office space, and 57% of those are already expansions. Now, 7% are actually new setups, and one of which is a cybersecurity shared services coming from the UK. So there are new industries, new countries, new skills being conducted in the Philippines. So despite all these challenges about AI reducing office real estate demand, etc., there are other industries that we expect to take up this slack. No, what's that third one?
So on rents, well, it has been flat in 2024, and we're still seeing some decreases or reduction, especially if your landlord situation is, you do have a huge chunk of space in your portfolio, then it's time to be very creative. And one of the best ways to be creative is rent reductions, and we've seen that happening all throughout the market, not just in Bay Area, even in spaces in Makati, BGC, for example. It's really situational, and we expect to see that moving forward. But we also see buildings starting to increase their rates because they're doing very well. So Dom mentioned, developers that are full to the brim right now actually doing very well. They now have the flexibility or the stronger position to insist on higher rates because of there's practically nothing left in their building. So on the other end of the spectrum, I think rents would reach their limit soon in terms of downward pressures, particularly in some areas like Bay Area, because you're now going to compete with the provincial market if you reduce rents even further than what we're seeing in the lowest rental rates we see in Manila right now. So if you do that, essentially you're competing with a larger larger supply of options in the market. And BPOs, our number one source of office demand, are really cost conscious. And as you have seen in the provincial slide that I presented, they're really interested right now in researching and studying other areas other than Manila and Cebu and Clark. So interestingly enough, when I talk to some BPOs who are concentrated in the provinces, when we mention what's happening in Manila, there's some interest actually to go into Manila. So like a reverse migration from the provincial locators, because the rents are already approaching what they are paying right now in the provinces. So that's quite interesting because it also, for them, it expands, of course, tapping their labor potential of Manila. What we always say for the provincial, biglang sinasabi na namin for Metro Manila. So it's, I think, it's getting there in terms of bottoming out, in terms of rental. And of course, yung land values, you see, if you can see there's some correction already. So there has to be a limit, of course, in office space rents, depending on those land values.
Thanks, Kevin. Danes, there's another one.
Yeah, one more question from this side.
Hi, I'm Ras Mercado from China Bank Securities. I have a question on residential inventory. So I think it's pretty consistent. It's been going up, but I want to ask a little bit more about the denominator, because from the last briefing, I understand it's a 12-month rolling figure. My question is, how's the movement there? Like, what's the underlying dynamic? Has it troughed out, or is it like improving? Or at least, because it would be good to have a sense of whether or not we're at take-up levels that are near pandemic lows. Are we somewhere near there, or are we better? And then what do you think needs to happen for that number to move higher?
So right now, our sales is at the lowest out of all the years that we've seen, even during the pandemic. Do we still see some fallout in the coming years? There might be still some for some areas, but hopefully this is the lowest already, and we'll start to see improvements in terms of the remaining inventory life this coming year.
And then what are the enablers for that denominator to improve?
Okay. Well, the developers are continuously trying to make their products more affordable. As you've seen, there's a slide that was shown earlier about the payment terms that are being offered in the market to move these products. The developers have also been selective in terms of their launches. No, they've tapered them down, and this is actually good because it shows how they've given thought on what they will prioritize in terms of their launches and their strategies. So focusing on, selling out their existing supply, bringing this down to a comfortable level, and choosing to expand in areas where there's more market, usually outside Metro Manila, where they're able to generate better values. So I think that's it.
Just to add, I think if you look at the denominator for you to improve the take-up, my take on that, it's an affordability issue right now. It is expensive. Then let's face it. The units that are out there are expensive. A studio unit at 300,000 per square, that's nearly 10 million pesos. So not a lot of people have extra 10 million pesos, well, at least not me, lying around just to get into that market right now, even though the terms are very good. So what are the things that needs to change? One is the price. You've mentioned that. And we're already seeing some price corrections in terms of when RFOs. Julius mentioned that a while ago, that there are promos that's happening right now. So that's good. Another one is the interest rates. The reality is our interest rate right now, our mortgage rate, while it has gone down, it's not as low as the pre-pandemic 5%. We're not yet there. So that also has been affecting the affordability. BSP has said that they're looking at further cuts. Again, that's going to help. What's the third leg that's missing? Salaries. The salaries have not increased as fast as the prices. You saw how fast the prices were going up every year. That was more than 10% of growth in pricing every year. Well, I don't know with you, but my salary wasn't increasing 10% every year. So that lagged in terms of affordability. There's another one which is not as quantifiable. It is the people's appetite for that risk. And it's not easily quantifiable, but at least those are very quantifiable factors. And I think those three, plus that appetite for risk and appetite to purchase, needs to happen. We're seeing growth. We're seeing improvements. Interest rates are going down. Pricing is really good right now. Secondary market, again, I said, in certain locations, primary pre-selling at 550,000, you could get something at 250. The next question is, do you have that cash right now to get into the market? If you do, now's the time, especially if it's end user. Go for it. Get those units, because I haven't seen prices that good. And then mortgage rates. So there are improvements. So hopefully those things start moving in the right direction, and we can see that denominator starting to improve.
Thanks, Richard. Louder, please, on the salary increase. We have a question from Mr. Manara.
More than 10%?
Hi again. I think there was mention of a specific factor that observers of the property markets are having difficulty trying to obtain, which is a real picture of land prices, land values, especially in the prime locations, because the owners of properties in prime locations are very few and generally have deep pockets, and therefore the market may go down, but they don't have to sell, no, unless they happen to be in trouble, no, unless they happen to have a debt pressure from banks or lenders. And so for an investor that has to see the land value as a significant component of his capital investment, it becomes, as Richard had mentioned, a matter of researching specific opportunities and finding out what's available and how much you can negotiate with the seller, with the owner. And from if you take the larger view, in the absence of statistics, is there at least anecdotal evidence that can be somehow tabulated, even if we know it's spotty, it's incomplete, but may be sufficient as an indicator in terms of identifying possible trends, and stuff like that. As an investor, it depends really on what your position is, right? How big is your, how much resources do you have? How much tolerance for risk you have? How long is your investment horizon? How much holding power you have to weather ups and downs in the market? So we've discussed this over years. Over the years.
Agree with you, Vic. We've had this discussion a couple of days now on on our view on the land values. Paul, give your views first, and then I'll add on to it.
Okay, on the land value, so you've seen drops in the projections that we showed earlier. So what we really see is values, land values particularly, especially in the CBD, is a factor of the utility or the use of that specific land. So what are the uses for, say, business district land? So it's either an office building, office development, or residential condo. And I don't want to, again, elaborate what Joey presented earlier about the state of both of those industries, and it's all going down. And of course, if you do the math, run the numbers, you will see that the value of land actually should go down. So some say that there are transactions higher than the numbers that we state. Probably so. So, but if I may quote Warren Buffett on it, so the price is what you pay, the value is what you get.
I agree. So, not just because there's no transaction, does it mean that the value of land stays the same? Because we already know that the prices have softened, and if you do your run of, construction costs, financing costs, and your land costs, with land costs as the last variable, it's not gonna make sense. It has to give, diba? The land cost has to go down, and hence we were brave enough to call that, because it does not make sense that in a market that there's no land transaction does not mean that the price is not going up or it's not going down, right? There has to be some value to that property depending on those. So I agree. Unfortunately, Vic, particularly in areas like Fort Bonifacio, Makati, Ortigas, wherein it's tightly held by a few that will not let go of those assets because they're diversified enough anyway, it's very difficult to find transactions. And it has always been that way for how many decades anyway, right? The only transactions that we saw in the previous cycle was actually not even land transactions. So there were some small ones, but it was really with a building, and you just impute the land because the building was so old anyway. But it was really far and in between in terms of transaction. So yeah, that's our take on it.
Richard, for your final remarks, please.
Okay.
Zoe, spot on. You also.
So again, thank you everyone for coming to our property briefing. We've shown you what happened in the last quarter. Yes, that was a retrospect, but here in Colliers, I'd like to think that we're more than that. We look forward. We like to look at the silver lining. We like to look at the opportunities. And while, for instance, the residential is quite tough right now, we had showed that there are pockets of opportunities in certain areas, certain price points, certain price bands, wherein the deals are very good. Office is the same. We do not generalize. While overall it's 19.9%, look at areas such as Makati, Fort Bonifacio, wherein we're seeing a lot of flight to good quality. Flight to cost is still there. But now's the time to also take advantage of that. Again, we look forward. We look at the opportunities in the market. And again, if you would need help or if you have any questions, please do not hesitate to talk to us, and we could help you and accelerate your success on that one. Again, thank you very much, and then see you again in the next quarter.
Thank you again, everyone. Colliers team, stay on stage for the photo. So please do get some food, and we'll also be going around. So I know a lot of you have more questions, so please do talk to us. Thank you, everyone.